Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
And we know that existing employees are busier. And it's difficult to, I think this is why jobs is such a controversial number, because it's difficult to, whether you're looking back, they can be revised, but to see how much of this reflects actual cuts or is simply reallocation of resources. In terms of moving to the equity markets now, well, the story clearly of the week has been the Dow at 50,000 and the earnings on fire, as we're seeing here, a new records being hit. It says here the S&P 500 earnings per share usually beats expectations, but not like this. For those listening on audio, it's a pretty, I'd say, a vertical line here up in terms of the Q1 2026 earnings season. So a bumper earnings season, maybe skewed by some of those big tech names that we've seen with their cloud revenue exploding. And that certainly has driven markets. But if we also look across the semiconductors more generally, really quite staggering performance here, which seems that there's just this insatiable demand for compute. And equally, it's not just a US phenomenon. We've seen the chips and picks and shovels elsewhere, and the demand for chips, say from Samsung, seeing a 5x return in the year to date even. So clearly something staggering going on within the semiconductor space. This does feel a bit like a melt-up or bubble. Would you share that, or do you think this is borne out in the fundamentals?
I do think that there's some concerns with respect to valuations and a melt-up. But with that said, we have seen a broadening out of equity returns. The Mag 7 isn't the entire driver of returns in the S&P 500. If you look at on a year-to-date basis, the 3 or 4 of those names are actually the ones that are of the Mag 7 that are driving returns. The other 3 are in negative territory. We've seen a broadening out of in other areas. Energy names, for example, industrial names, continue to help drive that earnings growth that we saw in the previous slide.
And this NVIDIA has done poorly here relative to Tower Semiconductor, ON Semiconductor, and Akamai Technologies. But this is the stock that has just crossed the 5 trillion market cap. And I think we covered it with bated breath when it covered past the 3 trillion market cap not too long ago. So I suppose, what does an equity market look like when it has behemoth stocks that dwarf what we would have thought about as a large market mover?
That's a great question. As you're mentioning that, I think back to the Toronto Stock Exchange when Nortel was 30% of the index, and in the early 2000s, and what happened there. I don't think we're quite in that territory just yet, but there are going to be some names that are clearly going to dominate, and we'll see what happens later on in the year if there's any change in or more concern about those valuations. But yeah, there is certainly some concentration in the market for sure.
But I think what is interesting here is the chart on the right, the age of ChatGPT. The market's view of who will profit most from AI has turned around. So this is plotting the SOX, the Semiconductor Index, relative to Bloomberg Magnificent 7. So we talked about rotations in the past, and we traditionally think of rotations as almost full rotations out of, say, tech into something more defensive, maybe into healthcare or financials. But even within AI, there is now a rotation out of the Mag 7, which maybe led the charge. We know that they are cash rich. We know that they spent a lot. We're following the money, essentially. What are they spending it on? It's already shifted into the picks and shovels. We know there are other ways to play the picks and shovels too. It could be data centers, it could be infrastructure funds. But clearly this has been an immediate source of following the money. And probably there's less concern about CapEx spend and its pressure on the balance sheet if you're the recipient of that CapEx spend, which is the state of the semiconductors. Are there any, I don't know that sector well enough in detail to know about the constraints that they may face, the semiconductors, the semiconductor companies themselves. Do you see that they will be supply constrained in turn?
I don't know the exact situation on the current supply, so I would not be able to say anything that would be insightful. I mean, historically, the supply have had a tremendous effect on their ability to not only produce, quality control, and other factors.
Yeah.
But I don't have a full understanding of the current constraints.
Well, I doubt your average stock market investor does either. I would suggest that the volume of flow into these stocks has probably taken place based on a lot of forward contracts, which have tremendous uncertainty built into them. And if you've listened to any of the recent, there've been a spate of long form podcasts with senior levels executives within, say, Anthropic, and they mention the fact that core to their agreements that they stack up is a tremendous amount of flexibility. Because they themselves are trying to prepay for at least secure compute with a large flexibility component, because they don't know how that compute will actually end up be needed, or in what way, or whether efficiency will dictate they don't need quite as much, or whether demand will dictate they don't need as much. So I think that massive flexibility like that is very difficult to model. So it would suggest that the demand for these stocks has not necessarily gone through that rigorous process.